The interesting thing is that, this has caused quite a panic, frankly, right? Even though we've seen not really a tremendous backup by historic measures, but of course a very significant one in terms of what we've seen for years and years and years, especially when you consider the hundreds of billions of dollars that have gone into the fixed income sector, right? I like to say that in fixed income today, it is the worst of times, it is the best of times. The best of times because of the amount of money that has gone into it. The worst of times because the opportunity set has shrunk significantly. And of course, the power of central bank buying has reduced the compensation for owning fixed income. When we think about how far can it go from here, I mean, we've just gone through really a late cycle fiscal stimulus. So it's not unreasonable to expect it to continue to go higher, although certainly not in a straight line. And I think as we stand at the top of 2018, the mantra for investors should really be, it's not personal, it's just price, to be extremely judicious, not only in treasuries, but across the board in fixed income. Are you getting paid to take the risk?
But Oksana, this latest move has really been driven by the international yield picture. I mean, the German 10-year, for example, in 6 weeks gone from 0.3 to almost 0.6. It's almost doubled in a very short space of time. So if this is led by the international picture, will it continue in the short term, or has that in fact run up as much as you'd expect in the short term?
Not at all surprising in terms of what happened to the German Bund when you consider the inflation backdrop, the improving economic backdrop, right? We've said for a while that the German Bund, particularly the mid part of the curve, is one of the most overvalued assets in the world. And a short, frankly, on that part of the curve is quite interesting because you can be short a negative yielding bond and actually earn carry, which is a first for investors everywhere in fixed income today. So again, as the global economic picture continues to improve, it is not unreasonable to expect that part of the German curve to go into positive territory altogether.
I'm thinking about that. You can short a negative bond and earn positive carry. I'm just going to move on to the dollar. Kathy, that's easier to understand. It's been going straight down. A guest just told us they think we're only in the first or second inning of the weakness. What do you think?
Well, right now we're not seeing any panic selling despite the U.S. government shutdown. And I think, while we could see a bit more U.S. dollar weakness, I think as we get into the phase where Powell takes over and we start talking about, the tightening cycle, I think even though the bond markets seem like, they could move lower, that the dollar is decoupling and you're probably going to see a limited decline because at the end of the day, the U.S. economy...
That is weird, right? I mean, the fact that the interest rates in the U.S. are moving higher and the dollar is moving lower, is that fundamentally strange for the currency markets? Not
necessarily if it's driven by bond selling, and that's really the case that's happening. And I think, however, as we move into the mid part of the year, what you're going to see is that the Fed is still going to be leading the pack. And I think at the end of the day, U.S. growth is going to be the strongest. I think, you're going to probably see the dollar bottom out shortly after the U.S. government shutdown passes. This is what we saw in 2014, where about a week after they extended the debt, they basically continued pushing the debt ceiling to February, mid-February, we saw the dollar recover. And I think, you're going to start to see that. And it's sold off aggressively. I think it's due for a correction, particularly against many of the commodity currencies.
Well, and that's been the interesting flip side. So we talk about how oil, Brent did it hit 70, John?
Yes, it did.
It did. So it hit 70. We've talked about, what does it mean that a lot of the metals and those sorts of things have been rallying? And what does it tell us about the economy? Is it all just the flip side of the weak dollar?
Absolutely. I was interested to hear what Kathy's take was going to be on that because I can make a bearish fundamental argument still, but significant dollar weakness would most certainly prop up commodity prices in general, oil in particular. But we saw tremendous weakness last week in the base metals. Despite dollar weakness, for example. So, there's something going on out there in terms of, supplies rushing to market as prices for metals and oil have rallied. Tremendous jump up last week in the U.S. Oil production, got to 9.75 million barrels a day.
And we're about to surpass Saudi, right?
Yes, we are.
We're going to do 10 million barrels a day this year, the U.S.?
Yes. And,
wow.
I'm not sure we'll take over Russia because they like to be like the New England Patriots of production. So they'll probably ramp things up just to stay number one. But, you referenced earlier about the meeting that occurred over the weekend among OPEC and non-OPEC countries that sort of monitor the situation with their production deal. And Iraq got called on the carpet. They got a phone call from the committee because they have been overproducing. They're all watching this U.S. shale factor start to kick in again in a meaningful way. And the way the Saudi oil minister was talking, like some of the comments he made, I thought he might have hacked my research server, because he's acknowledging the difficult time period we're about to enter. Weak demand from refiners because they go into seasonal maintenance this time of year. And again, this impressive growth in U.S. output. So I think, and you look at the chart, it looks a little toppy here to me, and we should be heading back lower into the 50s at least.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.